thinking about having a floor under the market.
Hi again, everybody. Welcome back to the Comstock channel. I'm Marlon Bowling with you, and welcome aboard as we recap Wednesday's market activity. With me, I have Joe Camp of Comstock Investments. We're going to take a look at what was driving the market. And far and away, I should say, the gold star went to the livestock trade once again. Joe, let's go ahead and start there. This seemed like kind of a historic day in the cattle complex. How come?
All-time highs. So we do have history made on these cattle futures. That includes the nearby live cattle contract settling above 200. Resistance possible, at this level technically. We talk about convergence at play in a big way as we head towards the delivery period for live cattle or the settlement for feeders coming up at the end of the month. But all-time highs and a big move up after what had been last week, and to start this week, some show of easing for this rally that had been now in place for several weeks. We look at, I think it's still being the case that speculative buying is more aggressive than the interest in producer hedging. And that can especially be the case as we continue to reflect on these strong basis levels. Why step into the futures market and sell a discounted board considering what we have out there in the cash and the incentive to feed out longer, especially in this cold weather, to slow down marketings a little bit, not unexpected. But back to that issue of convergence, we keep thinking about what will break first. Will it be the speculators that are going to rush to take profit? And does that pull down the cash trade, give the Packers a reason to step back a touch? Or is it that we do have finally some easing for cash values that triggers the speculative liquidation? And I think the speculators, they're watching the underlying fundamentals. They know what's trading out there, and they don't see yet a reason to ditch these now record positions. Net longs and feeder cattle, a new record last week. We're all but there on the live cattle futures. And so it is a watching of this cash trade and seeing if there's going to be any budge. Now, you could argue that might be nearing. We've talked about the fact that we're on the other side of the holiday period, that it was a real testament, a bullish testament to the strength of demand over these last several months that we've held up, and that we have observed this strong need for Packers to catch up. But then we wondered, are we at a point where they do catch up? And are we at a point where we do see, like this morning, some edge lower for cutout values that ultimately weighs on projections ahead? Do we have concern about, for example, immigration policy and these high prices, pinched packer margins, maybe leading to a shutdown for plants down the road that could weigh on things? But again, for now, you look at this issue of convergence. And to talk about nearby fed cattle futures just above 200, well, that's compared to a benchmark in the South that last week was 201, 202 trading this week. Up in the North, 206 to even 210 out there being offered. And in the feeder cattle complex, you have a cash index that has remained so much higher than the board value, still at today's settlement about $1 richer on that basis. So convergence really at play here. How much longer? Well, February live cattle futures will head into the delivery period on February 10th, and it'll be a cash settlement for January feeders coming up on the 30th this month. Until then, new all-time highs and bullish speculators in control.
Well, something doesn't seem to jive, though, because here you have the consumer. From what we understand, they really don't have that much money to spend nowadays. It seems like the U.S. economy is not doing that great, although the equity markets don't seem to reflect that. But if that's the case, where is all this demand coming from? I mean, there are a lot of other options at the retail meat counter. It seems hard to believe that seems to be an insatiable demand for the highest cost.
That's what we keep looking at, talking about, thinking about this strength in the market being something that consumers will eventually push back against. And yet no real evidence of that. Again, especially through this last holiday period, I think consumers ate really well, and it included a lot of beef. I did my part with a prime rib. I know others did as well. you still go to the grocery store and you demand that high quality U.S. beef, the steaks, maybe leaning a bit more towards hamburger, and seeing some featuring of that all of a sudden here lately. That makes us wonder: are we finally at that point where that is true, where we could see some pushback against the higher values that would maybe make restaurants, retailers want to feature the hamburger? But you've got issues with imports as well, and the spreads, reflecting overall just tightness in a market that's, at least so far, not pushing back. I'd link it back to exactly what you said: the speculative interest and the observation of a now near record or new record stock market. So it's not yet. But it doesn't mean it's not close either when you talk about consumer pushback and ultimately technical pushback on the board, or an eventual correction, at least, could be close to ensuing. It just certainly wasn't today.
Well, if you're a cattle producer, how do you take advantage of this and put a floor under where we are right now?
Yeah, certainly the office is talking about livestock insurance, also put options to offer some flexibility, thinking about having a floor under the market, as you mentioned, and then depending on your risk appetite, using options around that. You look at a technical feature, and again, you're wanting to lock in these values and take advantage of the run up, but it is more difficult because of going back to where we started, which is the very strong basis. And so you're less inclined to just jump right in, and more dragging your feet and wanting to delay and take advantage of the strong basis, which itself is a reinforcing factor of the strong basis. The wait and hold is continuing to keep ready cattle away from the market. Again, you could throw in cold temperatures as well, and all that's going on here, optimism and enthusiasm about price potential going forward in so many markets, maybe keeping producers slow to pull the trigger. At the same time, back to what we said, it doesn't mean that we're not still wanting to take advantage of the rally and to do something about it. It's just that for now, that interest is quite simply less powerful than what we're seeing from the buy side.
Well, and what was especially impressive was the fact that we closed right at the highs of the day on the cattle complex. That kind of stands out as well. Meanwhile, you look at the lean hog trade, and here they didn't have as much success, and they're still actually kind of following in a downtrend mode. I don't know how long they can keep that up while the cattle continue to go higher. What do you think about all that?
You have a split market with the hogs, truly, between the nearby contracts and the deferred months, with relative weakness up front, better strength out in the summer contracts, whereas you have a really pronounced resumption of a much deeper correction noticeable in the nearby. We're now only about 4 sessions removed from new contract highs on, say, the June contract. And so there has been this bear spread that's been more friendly to the out months. That might not be overall friendly for flat price when you have the nearby contracts leading the way. It can mean, in my mind, and likely has been, a confirmation that in these recent weeks, speculators have been taking profit and liquidating their long positions. Rewind about 6 weeks ago, there were new record net longs built up by managed money in the hogs. And so I wonder if that is, by the way, a bit of a playbook for what we can see out of cattle, that eventually those hedge funds do lighten up on their positions, and that they do take out a relatively bigger chunk out of the nearby contracts. And so as to leave still strength potentially down the road for the deferred or summer contracts on cattle. It's the same storyline in terms of the supply side. We're just not rebuilding as fast as we thought we might several months ago. And for hogs, the story is that we can rebuild this herd, and that we should be expected to grow production into 2025, but not until the back half of this year. And so that might support what we're seeing in the contracts out April and June, where you still have the projection for output on pork production to decline into the first and second quarter of this year before it ultimately turns higher again. So a lot of spread action, maybe more so in the hog futures right now that defines the trade. Although I could say the same today for cattle futures. That is a market influence that we're looking at, that coming up against these expirations, you have positions being rolled from the nearby contracts out into, for the case of feeder cattle, the next up March, which was the best performing of the day.
What about in the grains? Most of the grain markets closed lower on the day on Wednesday. Now, they had some big moves the previous session there. Did that throw any cold water on the recent rally that we have had there?
Yeah, let's flip this conversation about the cattle and the hogs and what we'd observed recently for that market relative to the speculative positioning against commercial hedging, and apply that to the corn futures first, which have this morning tagged at just above $5, that psychologically critical point, which we know to not only bring about possible technical selling interest, profit taking on these really hefty now net long positions held by the funds, and farmer selling interest, again, where you get this tranche of rewarding the rally that occurs also within the month of January, that we know to be, outside of harvest months, the heaviest selling month of the year, new tax year here. We are seeing farmers take advantage of the recent strength. We're talking about more than $1.25 up from the August lows on a continuous basis. And so that's what I think we're observing, a combination of farmers selling and speculative liquidation here that brings the nearby contracts down by relatively more than the rest of the futures curve. We always think about that the speculative position, where it's at, normally up in the front of the futures curve, is going to lead the way when we do observe that speculative exiting. And it's not a wholesale shift in sentiment, and it doesn't have to be for cattle for that matter. And it hasn't necessarily been yet for all of the hog contracts, where these speculators can take profit, can position for a correction, but not at all reduce or erase these net longs that are still held in the market. So for now, we're calling it still corrective in nature for what can ultimately be a broader turnaround for the grains. We're still enthusiastic or bullish leaning in the follow-up of that last crop report, and you can still see overall the bullish sentiment spilling over from the outside financial markets. And with all that's going on politically, the market, for the most part, has wanted to be long here, but today's turnaround does put a pause on that for now.
On corn and soybeans, we saw a lot more weakness on the nearby contracts than what we did on the new crop months for this year. How meaningful is that? What's the market trying to tell us there?
Yeah, I go back to the speculative positioning and the fact that your bullish bets from the managed money crowd are going to be by and large positioned in the nearby contracts. And so when they have a turnaround like was observed today, and they decide, okay, let's go to the exit, let's not be the last one out either, let's take profit and head to the sideline to see what's next, that's going to disproportionately impact the nearby contracts, just as those contracts led the way up as those bullish positions were being built. We're talking about, again, 300,000 contracts net long on the corn. And now the first time that these hedge funds have flipped now from net short to net long on the soybeans. But after what I mentioned for corn, more than $1.25 rally since the August 27 low. For soybeans, you're talking about considerably more than $1 worth of gains over the last month. This is something that the speculators are taking advantage of. And the other item is that farmers are too selling into this rally. They had, relatively speaking, we talked about this last week, more soybeans than normal left over that they could lean into this rally with, and they're seemingly doing that on a day like today. Not in a huge way, but when you talk about farmers selling old crop, you're going to think about letting go of contracts that are hedged against the nearby contract at the elevator or what have you in their brokerage accounts. So the pressure on the March leading the way, the nearby contracts softening up, but nothing out of control. This is only a reversal of, again, what has been a more active bull spread lately.
Wheat had a big up day on Tuesday. They gave part of that back here on Wednesday. Was that more related to the cold weather, or is wheat finally waking up from its wintertime slumber that it always has?
Yeah, in part, you just simply saw wheat tagging along with corn and wheat and waiting for a direction. It was last week that those concerns about the crop in the southern plains and these extremely cold temperatures really juiced the market. And it did so enough that there was notice taking by the speculators who, opposite of corn and wheat, remain heavily net short in these wheat futures contracts, opposite of corn and soybeans. And so they're saying we don't necessarily have to turn bullish, not to the degree that we are on corn and soybeans, but given wheat's relative weakness compared to those two contracts, it may stand to reason that we can cover our short positions, take profit on that side, and that allows the upside we've observed now just over the last 3 sessions, really. The computer algorithms jump on a day like yesterday where you cleanly jump above the mid-range 20-day moving average, and you gain some momentum on those types of studies to reinforce that buying interest. But then on today's move, when you don't have the tailwind from corn and soybeans, you also look at a chart that very short term, because of the run we had, particularly yesterday, leaves this market perceived as short-term overbought just by the position on the upper Bollinger Band or compared to resistance at some of these minor moving averages that folks are looking at.
Any outside markets catch your attention here on a Wednesday? I see where the energy markets were a little weaker, and it's a bit of a surprise with the cold weather outbreak. You would think there'd be a lot of heating oil demand, for example.
Yeah, to start with the energy market, I think you're having ramifications related to the political influences and this remembered concept by every trader that President Trump has talked about: drill, baby, drill. It's expand and deregulate. That was part of these first round of executive orders. So to expect production can grow from here in the U.S. Has been more of a negative feature for this market all of a sudden, but it goes along with just the perspective of having just had a considerable rally over the last month, having not long ago been under $70 a barrel, and now just last week touching just below $80 a barrel. So a $10 rally in that short a time. Now some profit taking, some of that fundamental influence souring the bullish stance for now, but nothing out of control, right in the middle of that $70 to $80 range, and waiting for the next step. It could be Russia. We could bring them into play. What's going on politically there, the war in Ukraine. It could be the Middle East with what has been an easing of risk premium related to the ceasefire between Israel and Hamas, or it could eventually be the potential for re-flaring tensions with Iran. That's one thing I'm going to put in the back of my mind that could possibly be a bullish feature long-term, unfortunately.
Good point. All right. Well, Joe, good to hear from you again. Thanks for the update on Wednesday's trade. Joe Camp with us. He's with Comstock Investments, and that'll do it for today's episode. Thanks again for joining us. For producer Breanne Jenkins, I'm Marlon Bowling, and we'll catch you next time here on the Comstock channel. Futures trading involves risk. The risk of loss in trading futures and/or options is substantial, and each investor and/or trader must consider whether this is a suitable investment. Past performance is not indicative of future results.